Welcome back, everyone. We're kicking off the day with a deep dive into future opportunities in the equity markets through the lens of some of the sharpest alpha generating stock pickers in the industry. The art of stock selection and alpha generation is what separates the good from the great in investing. With markets experiencing a tussle between the bulls and the bears, there have been some sectoral rotations and global macro uncertainties. And in this scenario, where do the best fund managers see the next big wealth creation opportunities? How do they navigate market cycles, identify multi baggers, and manage risk while maximizing returns? To answer these critical questions, we have an exceptional panel lined up today. Mr. Amit Jeswani, founder and fund manager, Stallion Asset. He's a double charter holding both CFA and CMT credentials. Mr. Jeswani brings over 14 years of experience in capital markets. Having started investing at just 16, his expertise in both fundamental and technical analysis makes him a unique force in alpha generation. We have with us Mr. Pankaj Murarka, founder, Renaissance Investment Managers, and he comes armed with over 2 decades of experience in equity research and fund management. Mr. Pankaj has a stellar track record, including his tenure as CIO at Axis Mutual Fund, where he managed over $2 billion in equities and delivered market-leading returns. We also have with us Mr. Arun Subrahmanyam, founder and partner, Ampersand Capital, with nearly 3 decades in the industry. Mr. Subrahmanyam has been a managing director at Bank of America Merrill Lynch, a top-rated analyst by Institutional Investor, and a veteran in equity research and investment strategy. So as you see, this is a very power-packed panel, ladies and gentlemen. The session will be moderated by Mr. Kamal Manocha, who is the founder and CEO of PMS AIF World, where he leads both wealth management and content initiatives with a strong focus on research-driven investing. It is under his visionary leadership that the firm has introduced several innovative investment frameworks, the last being the quality, risk, and consistency model designed to provide deeper insights into portfolio management services. PMS AIF World serves 600 plus high net worth clients, managing assets worth rupees 1700 crore plus, reflecting its strong commitment to delivering quality investment services. With 20 years of experience in the financial industry, Mr. Manocha has consistently driven strategic growth and thought leadership in the investment space. He holds a master's degree in management and an honors in economics, along with multiple prestigious investment certifications. And now, at this session, he's our moderator. Mr. Manocha, it's over to you.
Thanks, Aishwarya. We have, this crystal gazing summit going on, and yesterday's day was very successful. And I'm honored to again do this panel discussion with 3 prominent fund managers whose products we have given to almost all of our clients. And this is going to be more realistic discussion and more, I would say, friendly discussion, because I want to do heart-to-heart conversation in times like present, because investors really want me to do that. And we know that these 3 fund managers have delivered massive alpha. If I was to give context to our audience, Amit would have delivered broadly 80% returns in 2024. Arun would have delivered broadly 70% returns in 2024, and Pankaj would have delivered broadly 40-45% returns in 2024. So these returns are like unheard of. 2024 was a very phenomenal year, but after that, now in 2025, as year has started, January itself has kind of given us the reality check, whereby Amit has been down broadly 12% in single month. Arun was down broadly 14% in single month. Pankaj was down broadly 6% in single month. So, these are like, obviously we are prepared for this. And when we know that we have seen such good times in 2024, we have to be prepared for such times as well. But in times like these, investors really, want to verify, are they invested at right things? So my first question to you, Arun, what differentiates you here in this, I would say, panel is, I think, experience. You bring 30 years of experience. If Sumit would have, if Amit would have, say, 15 years of experience, you bring 30. So what is it that additional 15 years of experience tells you about the current phase of market? Because every time when market falls, this, we need to verify this. We are here to ultimately, enhance confidence of our clients, build better conviction, give them better clarity. How do you see current, I would say, phase going on, and what is it that extra comes with your 15 years of experience when investors have given money to you along with, say, Amit?
Actually, it's a very difficult question to answer because I can't speak on behalf of Amit. See, what Amit has learned in 15 years, I probably would have taken 30 years. I mean, that's probably what I can say. The only possible difference is that in the extra 15 years I have been in markets, I have seen more economic cycles. We have seen the taper tantrum in 2012-13. We have seen the financial crisis in 2008, and then there was this Nasdaq meltdown in 2000, and then the Harshit Mehta, Ketan Parikh, all of that, the Max scam. So all of that, one can say I've gone through. Now, what lessons I may have learned out of that? God, I don't know how, because every time you come to a new cycle, you do think that you have learned, but somewhere along the line, you tend to kind of skip some of those basic principles. And that's probably what has happened even in 2000, the latest one, the meltdown which happened since September. Market peaked in September, and October onwards, we've been seeing a kind of steady downtrend. And January, of course, was a calamitous downfall. February also has not been good, right? February has been actually quite bad broadly. So, these things do happen. There were excesses built in because of the fact that people went haywire and started buying randomly. I mean, obviously, the whole cycle starts with value, and then they get into growth, and then, of course, they get into momentum investing, and then people get into, looking at various avenues. I know lots of investors have asked us, why did you actually try and get into unlisted equities? Because that's where all the, you're getting stocks at great valuations, and once they get listed, you can actually make a killing and things like that. So these kind of excesses is something which we should have foreseen. In some sense, we did, because the kind of IPOs which are actually coming in every week, OFS, IPOs, promoter offloading their stakes. So these were warning signs. So while I did see this coming, for example, we did in our fund see this coming, the intensity of the correction has actually surprised us. Not because it has actually impacted a certain group of stocks, a certain, it's not just small caps and big caps being affected. I mean, even a lot of large companies were affected quite badly. Some of them, of course, in our portfolio as well. The ones which have been spared have been select nifty stocks. And probably we'll ask that question later. But anyway, those are the ones which have been spared. So I don't know how many portfolios have actually managed to have that perfect mix of having those boring nifty stocks and the more exciting, let's say, smaller names. We thought we had that, but obviously it has not been the case. So yeah, I mean, so in terms of experience, like I said, I have seen it all, one can say, but there's always new things to see and new things to learn.
Is there anything which is bothering you, particularly this time, Arun? One last minute.
Actually, this time I'm actually less bothered than what I was earlier. I mean, in the sense that I was not that I was managing my money and all that, but the fact is that this time I wouldn't say I'm relaxed. Obviously, I'm worried because when I'm not only handling my own sponsor money, but it's also money of all the investors who actually reposed faith in us. But this time, the reason why it actually I'm a little more sanguine is because, unlike most other cycles we had in the past, there was always some kind of, I mean, I don't know, for lack of a better word, I would call it a scam, but some kind of scam, something associated with a scam which happened in earlier times. And the banking system was in a big mess, the financial system, and that has changed dramatically. Today, you don't have a situation where your banking sector is stretched or has an issue. So while this correction, I don't know when it's going to stop. My gut feel is that it's probably very near the end, at least in terms of price, if not time. But I don't want to suggest that to anybody at this point in time. But I'm much more relaxed this time in terms of how this situation is going to end.
Sure, Arun. Well put. Moving on to you, Amit, you have given your clients so, I would say, large expectations that clients now expect even more. And hence, this question to you, you have been, I would say, one agile fund manager who has been absolutely working hard and focusing on earnings, and throughout, in fact, you made some changes in your process that, during the earning season, you're not available on calls, and, the investors cannot see their stocks live because you want to focus on earnings and want to kind of, definitely go right. But when we know that you had given 85% returns already in 2024, and the quarterly earnings were gradually coming down, your portfolio was having stocks which were so high on PE, though they were very good. I am personally invested in a portfolio, but investors really want to ask somebody like you who was focused on knowing earnings, how did you not take a call in 2024, maybe October, November, December, on sitting on cash or booking out of some of these high PE stocks? And in January we have to see a fall, and now you are adding on to cash, and kind of now you are trying to maybe rejig your portfolio.
So thank you so much, Kamalji, for having me on this conference. Thank you so much for giving me this platform. Thank you so much, Arunji, for the kind words. Now, coming to our portfolio, why did we go on complete cash? We don't do those kind of things on going on complete cash. We don't know what the markets will do. What we try to do, Kamalji, is to buy the top companies or executing, even the ones that we have sold. If today we have around 20% cash on the portfolio, I am very sad that I have 20% cash on my portfolio. I'm not happy. If you ask me what gives me sleepless night, I'll tell you my 20% cash position is what giving me sleepless night, not the 80% which is invested. Because in markets, your downside from these levels, I think, can be 5%. I don't know downside, but I think the upside, if we get it right in few of our companies, will be around 100 to 100%. So we are always bullish. There are still companies which are growing at 30. So what happened, Kamalji, I'll tell you. In India, there were just 1 second. So sorry. There was just something going on in office. I had to stop that. But in India, there were only, like, in every sector, there were like 4 companies, or like said 10 companies were there in every sector. Only 1 company or 2 companies. Basically, 80-90% of your market was growing at 5%, 10%. And then there was in every sector that superstar, which used to grow at 25-30%. And my money and a lot of other people invested majority of the money in the companies who were performing well. The problem happened when FI started selling. And they sold around 80-90,000 crores, and there were no buyers down. Because when you sell, these are typically stocks which are FI loved. Mutual funds mostly buy utilities like power grid, etc. Very 15%, 10%. They're okay with that kind of growth. We at Stallion want higher growth. It's our strategy. But I fundamentally think that we will focus on execution. We will focus on earnings. There'll be changes in the portfolio. Changes in portfolio are not because of valuation only, Kamalji, that are happening. Changes in portfolio are happening because competition intensity has changed in some companies. So wherever there is change of next 4 quarter, so we for us it's simple. But we don't think 10 years. We think what will happen in the next 4 quarters. If we think the next 4 quarters growth will still be very high, we have not changed our positions. And that is what we do in every bear market. Bear market, bull market, it has got nothing to do with us. Our strategy remains the same. But if we see earnings growth and that the next 4 quarters earnings growth, but right now there is competitive intensity has changed, so we've changed in a few stocks. So this earnings season was a very poor earnings season for us. That is something. See, every mutual fund that was up 10%, 15% also last year, Kamalji, they are also down 10%. Most of them on average. If we are up so much, it's okay for us to correct. But in this process of correction, we still have to buy the right stocks. We still have to buy the right businesses. And it's nothing to do with small cap, mid cap. All this. If 100 crore company profits in 3-4 years become 500 crores in a small cap company, you will make tremendous money in 3 years. In a large cap counter, if 1,000 crore profits after 3 years it stays at 1,000 crores, you buy large cap company now also you will not make money. All I'm saying is all this small cap, mid cap is for big people, for mutual fund, this, that. We are very small. Our entire industry is 4 lakh crores. That is size of one mutual fund. So we have to focus on things which are controllables, earnings. What Trump will do, we don't know all that. I have zero idea. I don't even think so much. We have to focus on, but in market leaders, not in the 10th best company growing at 30%. It will continue that growth or no, you don't know. So you want to be with the best companies. We have not gone down the quality curve. If you see our quality of companies, even the newer investments we are made, they're all market leaders. Growth of 25, 30%. We've entered some lending businesses. Markets are telling us enter lending business. We are entering. If 5,000, 80,000 crores of FI selling is not taking the lending business down. It is Mr. Market screaming. No one in his life has made money without accepting Mr. Market. Like basically, you cannot be against the market and make money. You have to respect the market and make money. This is what I think. Like this is what works for us. So we have done some changes in the portfolio, and but we are on cash, and cash is giving me sleepless nights. That's the only thing I would like to say. That we like right now it's not so easy allocating capital, but we will get it right. Earnings season just ended yesterday, so we need to now work harder this year. But it's not going to be a rocket year. It doesn't look to be a rocket year because we don't have so many rocket earnings. And you want rocket earnings and rocket valuations. Basically, the sync should be low valuations and rocket earnings. That sync right now is not there. You don't have rocket earnings or rocket valuation right now. So we should expect this year to be a medium kind of year. Then next year we'll have probably things will change, new IPOs, demergers, somewhere you'll get value. But our process will be same. Focus, you will not, I don't think it is very tough to make money without companies growing fast. Or you buying, you want valuations, earnings, those things, and going up, going 50% cash, 60% cash can be an outcome. If it happens as an outcome, we'll do it. But it's a very tough thing. Majority of large alpha losses in PMS history also has been happened by taking cash calls. We don't have to be super this thing. We have to be with the market and try to be better than the market all the time. And this is what I think, but I can be wrong also. This is, for me, everything is a learning curve. If someone has taken cash calls and we've not taken cash calls, we are thinking that how was that person so smart and how are we so dumb? But we're still seeing, when did he take the cash call? What was his drawdown? So we look at everything but if someone's done better than us, we look at that person also, and we try to learn things from everyone.
No, sure, you are still better than the guys who took cash call because you respected Mr. Market last year and were like riding the wave when markets were up and took a cash call now. But it's like, as I said in the beginning, investors really expect much more because you have raised their expectations. But well put, I understand, your point. It's giving you sleepless nights to be on cash. And it's tough to take a cash call for you, which is like good because you always have, not a dearth of ideas, which maybe other fund managers were struggling to find, and hence they took a cash call much early. Moving on to you, Pankaj, I think, when we started, both the other fund managers did compliment you that you must be kind of at a relatively easy times as of now because your portfolio is relatively far more balanced. Like you have large cap stocks which I think may have fallen early in the first phase of correction, but in the second phase, you are kind of saved. My question is a little different. Like Amit is very agile fund manager who would have taken out some of the food delivery names he was talking about, or he earlier had names like, for example, Paytm in the portfolio. He took that out as well. But you on the other side, I have seen in your portfolio, you have a mix of, on the one side, large cap stocks, and on the other side, maybe some of the upcoming emerging, businesses like Zomato, Paytm, and all. But whenever these companies go through bad quarters, you stay put on them. Like Amit says, I don't know what is going to happen in 10 years. I take a 4-quarter view. But you seem to be kind of, holding on and kind of having a long-term view. It did work for Paytm. Paytm did go down to 300 and has come back. Now again is struggling. But what makes you different, and how are you able to hold? Have you just kind of held on to Zomato even now after the last quarterly earnings, or you have also taken some similar decisions of kind of pruning down your position?
Hi, Kamal. Thanks, and morning to all your viewers. Well, I understood some part of it. I did not understand completely in terms of what some of the other participants said, but let me talk about what we do. I think from whatever little I understood, we are exactly opposite of what, let's say, Amit said or what he does. So, and this is what I've been doing for the last 26 years. This is my 27th year into the profession. So we're extremely lazy. हम लोग काम ही नहीं करते हैं, हम लोग खाली आराम करते हैं. which effectively means we think only in terms of time horizons of 5 to 10 years about businesses. We take a very strategic view on businesses. We don't take cues from markets because we believe that market is an outcome. We invest in businesses. When we invest in businesses, we are buying those businesses. We buy those businesses basis our underlying understanding and fundamentals of those businesses. Sometimes market might price them business as well. Sometimes markets might misprice them. We don't take market behavior or market cues as an output or a judgment on our fundamental analysis. There could be mispricing in markets of businesses, and if whenever that is the case, we that's an opportunity for us. If the stocks are undervalued, that's an opportunity for us to go out and buy more. If there is significant overvaluation, if there are short-term aberrations, we still tend to live with that because our investment horizons are to begin with at least 5 years. And there are stocks which we've held in our portfolios which are over 5 years. We've been holding stocks for 7 years, 10 years, and stuff like that. Even in Renismo, from the time I started almost 7 years back, there are stocks which we've been holding for last 7 years. We invested into Sun Pharma in 2018. It's still part of our portfolio. We've been holding some of the other names like a State Bank of India or a Cummins India for almost 6 or 7 years now. So the point I'm trying to say is we take a very long-term view on businesses. We take our time horizons are 5 year plus. We understand that there will be short-term variations in markets and all of that. Doesn't bother us. Market volatility or corrections doesn't bother us. As investors, we are never chasing high returns. What is more important for us is sustainability of returns. So we want sustainable returns. And we want long-term returns. So we want long-term compounding, which is where the school of thought we come from or our ethos are. So we're always thinking in terms of time horizons. Our whole investment framework, research framework revolves around thinking about businesses from a time frame of 5 years, whether over 5 years, what this business can translate in terms of returns for owners and shareholders like us. And in during that journey, obviously, we think through macroeconomic events that can happen and how whether the businesses and the management team running the businesses are they capable of handling those challenges and so on and so forth. As long as business is in the right direction and markets are pricing those businesses reasonably around fair value, because fair value is not a one single number but a broad range, let's say, from a market's perspective. We are happy to stay put with those businesses. As investors, we tend to be growth biased. So we're always looking to invest into growth and high growth companies, companies which can compound over a long period of time. More importantly, companies which can deliver that growth consistently over a long period of time. So our approach is very different in that sense, and which is where, short-term movements in market doesn't bother us. I don't get sleepless nights. I sleep very comfortably. I'm a marathoner, so it's important that I sleep well because I start my day at 4 in the morning and do my toughest of drills in the morning. So I sleep very comfortably. And generally, we don't. In my 26 years of investing experience, I've never had a situation in India where I'm short of ideas. Even when I was running Axis, I was running $5 billion US, 50, almost 45,000 crores in Indian equities. I always had more ideas than the money that I had at my disposal, because the beauty of India is that the pool of high growth companies, high quality companies keeps on expanding year after year. And now that India is the fastest growing economy in the world and will probably stay there amongst the major economies for the next 20 years, I think the pool of the kind of companies that we invest into, which is high growth, high quality, sustainable growth, high quality management teams, that universe of those companies is expanding at an exponential rate. So, you're always excited because you have so many of those opportunities. You're never short of ideas. We are not trying to play the market from a 3 month, 6 months perspective. I have no idea. Meaning, I can lay out my views on how I think about markets in this cycle and this thing if your viewers are interested into it. But when it comes to investing, we don't make an investment basis market behavior, market outlook over the next 6 months or 3 months and all of that. We might have views over a year or 2 years, but we don't overlay that on our investment process, because investing for us is a very much a bottom-up, fundamental, deep, fundamental oriented, long-term process, and it takes a long while for us to invest into companies. We don't invest so easily. Having invested, we don't. Always say that we don't invest easily. Having invested, we do not disinvest easily because we're not buying stock prices. We're buying ownership rights in business. We're owners of those businesses. We're thinking about we have very deep engagement with businesses, management teams. And then along with the management, we are taking a view which is very strategic. But having said that, if we think fundamentally things have changed or something has gone wrong, then we do take corrective actions. So we are the proverbial classical tortoise in the classical sense. And I firmly believe eventually the tortoise wins the race. That's our approach to investing, and all of that effectively means I sleep very peacefully. Unlike others, or I don't know about others, we are low risk investors. We do not have high risk appetite. Long-term investing there's a difference between long-term investing and trying to play momentum or speculating. Investing by itself effectively means generating healthy returns on a sustainable basis over a long period of time with low risk. Investing is not a high risk business. Investing is not high risk. High risk, there are other parts of the markets or other way you play the market that could be high risk. Investing inherently is a very low risk activity, and which is what the beauty of investing is, that with low risk you can generate high returns and healthy returns, and that too on a sustainable basis over a long period of time, and which is where the true wealth creation kicks in. So for us, we are very, as I said, we are the proverbial tortoise. We are very slow in acting. It takes us a long while to invest. And having invested, we generally tend to stay invested for a long period of time, So that effectively explains our approach. And businesses go through their cycle. As long as we think the long-term strategy of the business is in place, the growth plan, business is still on a strong growth track, management is doing the right things and strategically executing well, we stay put. So we are the ideal kind of investors that a lot of our companies probably would love to have, because we engage with them very deeply. More importantly, once we make that investment decision, we stay invested in those companies for a long period of time, unless they screw up on the business.
Sure.
So, yeah.
Perfect.
If
So I'll
it
come back
interests
to you.
at some point of time, I can lay out my views on the market or the economic cycle if you think that is of interest. Sure.
Absolutely. I'll come back to you subsequently. Yeah, on that. So moving on to you, Arun, I know, you have a very different approach than Pankaj, and your approach is similar to Amit. And, we are here wanting to give alpha to our clients. This is the panel all about. So obviously giving alpha in 2024 was all about being agile. And now giving alpha in 2025 when markets are down is also about all agile. For you, you are not wanting to stay silent and have I would say, a peaceful night. You want to always come morning, thinking, seeing market and kind of either you're wanting to change a stock or wanting to increase cash. So what exactly are you doing? How was January for you different, or how is February for you different, or how is 2024 different for alpha generation for you as I would say, daily routine or as an approach versus maybe 2024?
Yeah, so let me correct you here. I'm sorry, and no disrespect to Pankaj or Amit here. I am not like Amit and not unlike Pankaj. It's a kind of, there's an overlap everywhere. I mean, we are a long only fund. It's an AIF. We don't like actually buying and selling. Like Pankaj, we have a lot of stocks which we have bought since inception and holding since inception. I mean, names are not important here, but you know what we hold. And there are some which we probably bought in the last couple of years, and we may not be holding some of them either because they've given us outsized returns, or some of them which did not turn out right. So we actually believe in the basic philosophy of long-term investing. So which is why I said we are not unlike Pankaj, but at the same time we are cognizant of the fact that investors who look at us to deliver alpha would like to see not just consistency but probably superior returns all the time. Not that the latter is not possible. I mean, it happened in the last couple of years. But over the long term, if one can generate a 5% alpha yearly, I think it's a big number. We actually did better than that in the last 2 years, so that some kind of normalization probably was overdue, and it's kind of, I won't say it's happened, but it's probably happened in January. I mean, I would like to believe so. Now, coming to the second part of the question which you asked in terms of how January and February. See, we before getting to January, October was not a good month for markets. While we did well, but it was not good month. November was not good. December was a sham because the first 15 days was good and the next 15 days was very bad. So again, December is not good. And January we all know, and February also is very similar to January as it seems, as far as the market is concerned. But we kind of recognize the fact that there is an issue in December. So we started taking corrective action in December itself. And unlike individual investors, we cannot change portfolios overnight, and we don't intend to, because we obviously looked at all our stocks where we have invested in, and a majority of them still retain the long-term thesis of sustainable growth. And the fact that they have actually corrected, some of them unwarranted, and some of them probably did warrant some correction. We believe that they need to be held on and probably even added to at the right time. So that is what we have done between December and January. So January actually, the fact that we did not do well, forget by our own standards, we did not do well. It is not because of certain category of stocks like a small cap and mid cap, nothing of the sort. I mean, some of these big blockbuster winners over the last 2-3 years, they were the ones which actually sank the most. And the names, whether it's Polycab or Trent or Zomato and all those things. Now you have to question yourself and see whether they deserve to fall that much or not. And we have kind of done our homework and looked at those numbers and did what we best thought at that point in time. So our portfolio has not dramatically changed between December and February, but what has changed is that we have actually now made it a little more concentrated. Stocks where we had a tail, where we had less conviction on, they no longer form part of our portfolio. And when you come to February, while we are down, we are actually seeing a significant reversal versus January. We are doing far better than the benchmark and mid caps and small caps. So obviously, I know the 15 more days left, so I don't want to take a call on what's going to happen in the next 15 days. But we are quite comfortable with where we stand. Like I said, our portfolio has not changed dramatically. We still are focused on growth and sustainable growth. And we obviously are cognizant of the fact that some companies which have run up too much, where the fundamental factors would have changed, only then we have taken corrective action. Otherwise, we've not really done anything dramatic. So that's where it is, and that's where we stand.
Sure, Arun. Sure. Perfect. So moving on to you, Amit, one question which, most of our clients have in their mind, and I am also invested in your PMS, is that to you, it seems that P is a, word that doesn't matter. Because what happens in these times, we are reminded, and I'll tell you, though obviously, your fund has done really well. But what happens when we talk about Stallion's product to our client and our client goes to some other advisor who doesn't have for example, Stallion is a product to talk about. The other advisor says, "Ki, sir, aapne usko PE dekha hai?" So this is how this is how people play against you. And till now, things were absolutely good because things were rising, but PE is still high. And now when markets are going through corrective phase, deglobalization kind of risks are in front of us, and FIs have been consistently selling, there could be tariff announcements. Obviously, you are absolutely focused on earnings, but in terms of valuations, aren't you worried? Don't you get this worry that your portfolio is like expensive? How do you kind of substantiate this particular part of your portfolio in terms of helping our clients have a conviction on your portfolio at these times? You're on mute, Amit. You're on mute.
Kamal, it'll be wrong to say we do only high P. We do wherever we see opportunity. If we see if P is because of growth rates, size of opportunity, market leadership, high ROC. If you have a large TAM, if you're selling specs, you have a large TAM. But if you're selling a tie, you have a smaller TAM. If your business ROC is 11% or 12% or 6%, and a business which has a 30% ROC, they will have different valuations. If a consumer-facing business and government linked business will have different valuations. A retail business, let's take an example of Walmart in the US with 4% growth rate, trades at 38 P. I'm saying, assuming Walmart US investors are smart investors, that is higher valuation. Costco, which grows at 6% in the US, trades at 58 P, assuming US investors are smart. I'm just telling you, like, different businesses have different PE models. If someone is showing you a commodity company at 10 P, that wouldn't be right to compare with a consumer facing company which is growing at 25%. So basically, all valuations will come to your Nifty valuations. Everything will get benchmarked to Nifty. Right now, Nifty is around 20 P. The growth of Nifty is around 7, 8, 10% earnings. Long-term earnings should do around 10, 11% for Nifty. And the ROEs of Nifty companies are around 13, 14%. Now, if a company grows at 3 times faster than Nifty, will of course have different valuations, and every year those valuations will keep coming down. This is growth investing, is what we practice. Every cycle we play very different. We don't we think that cycles are for 18 months, and the leaders of every cycle may be different, and some may be secular. So our judgments of our position sizing, our judgments of these are all frameworks that we discuss with our clients every quarter, and mistakes we keep doing. When I'm probably 25 or 30 years old, probably I'll do lesser mistakes, but we keep doing mistakes. We are learners, and we keep learning and trying to get better from every mistake that we made. But our focus remains on doing decent, and we try working hard, extremely hard, to make sure that we achieve our goals for our customers. But high P is wrong. In every quarter and every quarterly con call, we explain every client why we bought a stock and why 1 year forward the stock will look cheaper, or 6 months later. You have to get it right on valuations. If you have to get it right, I think, to make big money, you have to get it right on valuations, growth, market leadership, ROC, management, everything. And these are your corporate governance, and there are some risks that you're taking all the time. Sometimes we take valuation risks, sometimes we don't take business quality risk, we don't take industry risk. And if you don't take business quality and industry risk, then you are left with one risk that you have to take sometimes. That is valuation risk. So valuations are always looked at adjustment of all factors. Just buying a 10 P company doesn't guarantee you. And I would say the Nifty 500 stocks are there. Every 3-year period, Kamalji, there'll be many high P companies that will become low P companies. And there'll be many low P companies. Assuming 20 is the median P, and there'll be companies here, there'll be companies here. Many low P companies will become high P companies. But many high P companies today will also be outperformers if the growth of earnings is very large. As long as what we are doing, we are understanding what we are doing. As long as we take lower risk than the market, we are cognizant of the trust that people have shown in us and the amount of capital that we manage. So we are at our peak. We are trying. We take some risks. We are learning all the time. We are making some trials, some errors, but we make sure that we don't lose too much money. There are only 4 things that can happen whenever you make an investment decision: big profit, small profit, big loss, small loss. What we try to do via diversification and via making sure being disciplined, we eliminate big losses. So we are left with only 3 things: big profit, small losses. And that is why on other risk factors that we look at, we've done better than our own estimations, because we only compare ourselves to ourselves.
Sure, Amit. So moving on to you, Pankaj, we have only 10 minutes to go. So I just request you to keep your answers short, because I have to take, one question each from all 3 of you. So Pankaj, you in your last reply mentioned kind of, focusing on risk, that's absolutely something that you never want to kind of, increase in a portfolio, which is good, which, is something which every investor would like to hear. But at the same time, the reality is that whenever uncertain event unfolds, like COVID happened, even SBI fell 35%. Or Reliance Industries has, even in this correction, fallen, brutally. It's not like we can't say Reliance Industries has not fallen. So large caps or high quality businesses, it's like Bajaj Finance or HDFC Bank, have not performed at all in last bull run. They are high quality managements and high quality stocks. So when investors have given money to you to get outperformance, why not do that extra effort and maybe have some sleepless, some maybe, I would say sleepless night, and add in a portfolio and kind of be competitive. So investors would also say that, you are maybe not competitive. You're not wanting to give me that alpha. How would you answer to that aspect?
Not really, Kamal. If you see on a 5-year basis, our FlexiCap PMS has done 27% CAGR. Yeah. Investors who invest from a long-term horizon, which is what we do, while we do not chase high returns in the short term, as I said, investing is all about wealth creation. Meaning I'm just relating it to my own personal thing, the difference between sprint and marathon. The only reason I run marathon for 10 years now is because there's a high degree of correlation between investing and marathon, and I can relate to both. Both are long term. Investing is not about making the highest return in 1 year, but how can you compound? The magic of compounding is what creates wealth over a long period of time. What is Warren Buffett in one statement? Warren Buffett is 19.3% compounded over 30 years. It's not about 1 year, 70% return. It's about 19.3% over 30 years. Unfortunately, the second best investor is not close to Warren Buffett. Okay, the second best investor over 30 years is much lower than 19.3%. So what matters in investing is long-term compounding and not the short-term returns that you generate in a year or two. So to say that we are not doing enough is absolutely wrong. In fact, I think we're just doing the right things, and that given the fact that we own a significant part of our own funds in terms of having skin in the game, we're just doing the right things, which is necessary for wealth creation from a medium-term to long-term perspective. Because, as I said, we invest in businesses, we buy fundamentals, and we buy future business growth. Businesses do not happen in thin air or 1 quarter. Outcomes happen over a long period of time. If you're going to build a large franchise, a successful business, it takes 30 years to create an Infosys from a startup to being an index company. The latest example is Zomato, which happened in 13 years. From the time it got started, now in 13 years, it's part of the index. So you're buying businesses which will compound over a long period of time and create sustainable, as I said, one, long-term returns, and second, sustainability of those returns. Right? Those two things are important. And experience tells us probably only 10% or 15% of the funds are able to do it, or investment managers are able to do it over a long period of time. Because people do falter, or risks do happen when you're playing the short-term game. So I think our focus, as I said, just to reiterate what I said and to connect with what you said, why not take the extra risk? We are taking moderate risk or risk that is appropriate. The only thing is we think about returns in the framework of 3 years, 5 years, 7 years, 10 years. And as long as we're getting that right, the short term will fall in place. We are not worried about short term in that sense, because we're always thinking about 3 years, 5 years, 10 years. And the fact is that on a 3-year, 5-year cycle, I understand our funds are amongst the best in class in terms of performance. And I've always had that in the last 26 years of my career, that my funds have been among the top decile funds over the last 26 years, whether it's Renaissance or any of my previous roles at Axis, or before that, what I did for Merrill and some other organizations. Point number one. Yes, you're right. During COVID, some of the best companies. So the two other questions you asked, let me just pointedly answer that because we're running short of time. One, you said some of these companies have not done well, Bajaj Finance, HDFC Bank, and all of that. So yes, even these, every business goes through a cycle, which is where the stock selection and investors like come into place. For example, we have not owned HDFC Bank for 3 years, but now that's the largest holding in the fund now in the last 6 months. Because HDFC Bank went through a period of whatever business consolidation post their merger with HDFC, and we were ourselves somewhat more cautious, or we had a negative view on HDFC Bank. But now we have turned positive. I think over the next 5 years, HDFC Bank will get back to what it used to be for 20 years before the last 3 years, which is HDFC Bank went from being the fastest growing private sector bank in India to the slowest growing private sector bank in India in the last 3 years. We think in the next 3 years, they'll get back to being the fastest growing private sector bank in India. So now, for the last 3 years, we did not own HDFC Bank, but there's underlying change in the business. Now we own HDFC Bank. I think over the next 5 years, in the next 3 years, they'll get back to, and more importantly, over the next 5 years, they will be the fastest growing private sector bank in India. So now that we've invested into HDFC Bank, it's an investment for us for the next 5-7 years. So we take those kind of calls in terms of stock selection and all of that. So yes, businesses go through their cycles, and then you have to be careful. That is where the stock picking comes into play. Second, obviously, COVID was a dislocation where everything, the economy came to a stall, economies were locked down. Every country in the world, including India, had negative growth. So stocks will fall. Meaning you cannot blame a HDFC Bank management or a State Bank of India management for COVID, right? But the thing was, these were some of the finest managements dealing with an external disruption which happened, and they came out winners out of that crisis. So these kind of events, macro events or outlier events will happen once in every 3 5 years, and which is
Sure,
where the risk in the stock market investing
sure,
comes
sure,
into
sure,
play.
sure.
Your only defense in this kind of environment is being invested into the best quality businesses with high quality management teams.
Sure, sure. Perfect, perfect. Well put, we are
And
short of
meaning
time.
some of the best investors in the world, they sleep very well, including Warren Buffett. So you do not have to lose sleep to make money. That trade-off is not worth it.
No, I
You
agree.
need wealth as well as health. So, and you can achieve both in investing. That's the beauty of investing.
No, absolutely. Well put. So, moving on to last set of two questions, one from Amit and one from Arun. So, your question, Arun, is that you have been doing growth investing throughout, and growth is something, which is under question mark right now. But at the same time, market has seen some companies showing distorted valuations, and there could be a possibility of turnaround, which, like for example, Pankaj mentioned, HDFC Bank could be a turnaround. Right? It may not fall, I would say an attractive bet from your growth investing point of view because currently growth is not visible. But it could be a turnaround, what he's anticipating. And entire mutual fund industry I have seen has HDFC Bank as the top holding. So these, like, I'm just giving an example of HDFC Bank, like not a particular stock, right? So there could be certain turnaround stories in large cap or maybe in mid and small cap, which may be termed as value investing or not purely growth investing. Would you not want to blend your portfolio with those at this juncture when markets have seen a fall, or you want to only kind of focus only on growth investing as you have been doing throughout?
So again, Pankaj, there's a small. I mean, you're mostly right, and in fact, your question itself answers part of what you want to ask. But our portfolio is a blend of the companies which are high growth and some modest growth with low risk. So we have a blend of both. So I mean, we manage a multi-cap scheme, and a characteristic of our mix is a portfolio construct is also very similar to that. It's just that that the whole paradigm of saying that we should shift from growth to value makes sense if it makes sense if there is a very, very strong reason to believe that value will also start to grow. Buying value for the sake of value is not going to help. For example, I'll just take the example of HDFC Bank, which neither we own or whether I don't know whether we want to own or not. But the reason why it got derated, as Pankaj put it, is because there was a time when it was growing at 25% and growth slipped down to less than 10%. That's why it got derated. And it is not because of that, and it obviously you could always argue that it has value when on a price to book terms it has value because it is HDFC Bank. But the fact is that if HDFC Bank does not revert back to the older growth paradigm, then it will not do well. But if it does, then Pankaj will be right. Then it obviously will be one of the best stocks to own over the next 5 years. So the small answer to your question is that our portfolio is built around a mix of these growth and value turning to growth, possible growth. That is what we believe. And again, we have not sold out on growth, and the fact that we're not, when you say that the growth is a question mark, the question is how much of a question mark is it? I mean, the question mark will come only in companies where the track record is doubtful, where the company does not have a strong execution, a track record, but where companies are dominating in their very space which they exist, the chances of growth reverting back to what they delivered in the last couple of years is very, very strong. So that is the reason why we are continuing to hold on to those stocks which have given us alpha in the last couple of years. So I hope I've made sense. I mean, I was trying to make it very fast.
No, absolutely. It is all absolutely sensible. The only subsequent question, I take it from you, Arun, to Amit. This is the last question. Is that though obviously, growth is something which all of us love, but growth is expensive. That is where the question of value comes because something which is expensive could also be uncertain in the times of deglobalization. If you buy something which is expensive and future ahead is uncertain, then there can be accident there also. Why not maybe blend a portfolio and add value, because that is still certain, because the starting point is like there is a margin of safety. And I just remind you, maybe a few years ago, your portfolio, Amit, was a portfolio which was blend of, I would say, established monopolies like HDFC Bank, TCS, Infosys. But over time, it's become a portfolio of emerging monopolies where now you're only chasing highest growth, hyperscalers, as you say. So I'm just hence trying to remind you, given the current context of the uncertainties ahead and the times, how are you kind of wanting to kind of handle your portfolio? This is the last question to you because we are running out of time. Arun,
Kamalji has already initiated a lot
that
of
answer.
prudent maneuver.
Amit, just one second.
Yeah, sorry.
That question is for you. But I just need to add one word before you continue. See, when you look at our portfolio, since you actually compared me with Amit's fund, our portfolio was deemed to be expensive a few months ago. You can check on the monthly fact sheet of last month and probably this month. You will see a dramatic change. Not because we have changed our portfolio dramatically, because they have corrected, the stocks have corrected as they have, and the growth paradigm hasn't really changed that dramatically. And yes, we have added some value stocks, which we can discuss in another forum. Sorry, Amit.
Don't worry. Arun, the same with me, Kamalji. See, I have no promise that I will hold the stock that I hold today. My job is to make money for my customers. I have no this thing. Like, I don't know even how to say it. My goal is to make money for my customers. Now, it comes from HDFC Bank or Zomato. I have no interest in, because I don't know, even I've not met these guys. So wherever we think there's a framework, a repeatable pattern where we can make money, we will go to those kind of stocks. For us, the goal is very simple, that we want decent companies, like good enough companies. And if the market is moving to proven market leaders, we'll move towards proven market leaders. We are not emotional at all in our this thing, that we will be with. Our goals are very simple. If high growth investing, but I don't think that will happen, that hyperscalers will not do well. Right now, I don't think that will happen. But if you think about it, the fashion largest guy and the food delivery guy, they're now less than 4-5% of my portfolio. They used to be 16% of my portfolio. While the stocks were moving higher, things were good, outlook was good, they were 16% of my portfolio. Right now, they're less than 5% of my portfolio. Something new will come that will become 16. Our portfolios will always be with the market, Kamalji. And I want that, and it's only the gods know what will happen, but we will continuously, the thinking is that when you have growth, you have market leadership, and you have the markets beyond a point. 6 months from today, I'll be sad if 70% of my portfolio, or 1 year from today, 70-80% of my portfolio is not making new highs. Because how will you manage your risk? How will I know that I'm wrong and the markets are right? Beyond a point, if we are capital allocators, we will have to adjust our positions, and we would like to have majority of our companies making new lifetime highs, because that is where biggest money will be made. You want earnings, you want growth, you want lifetime highs, market leadership, and that is, see, I can, and 1 year can be bad for us. We can have a terrible 1 year, but if we have one bad year, we bounce back the next year. The process is where we are investing our money, our time, and everything. That how do we get better? For us, we have to get better every year, and it's a continuous process. And I'm telling you, we'll make mistakes. We'll make bad decisions, but we'll learn from every decision. We'll communicate to our customers if we made bad decisions, that we'll cut our bad decisions, and we'll try to making better decisions. It's a process of wealth creation that our customers, we are just managers. Our customers are the ones who have taken the risk of investing in us. And we as managers have to continuously, like, I think I need to improve. I'm not the best that I am today. I need to improve on productivity. I need to improve on stock selection, risk management, virtually everything. You said that, why are you down? I was feeling so bad. Why are we down? If can we do better? That's the whole thing. And that is what we keep thinking. We are not even close to our best. We are probably way lower than our best. We have to get good.
Absolutely, you are the best as of now, as per numbers. And I can tell you, like, if I have to sum up this entire panel, all of us are chasing alpha and all of us are wanting alpha. Like Pankaj is wanting to compound with consistency over longer term. But, his average returns are like broadly 25-27% on 5-year basis, which is like, again, alpha of broadly 8 to 10% over the benchmark. Arun, is kind of delivering around 30% broadly, and alpha of probably 12% on 5-year basis. And Amit, you are trying to maybe, go the fast. And that is where obviously, risks are higher. But at the end of the day, investors are, I think, wanting to give money to all three of you, because 25% to 35% is a range which like is very high, is unbelievably high. And I'm telling you, whatever discussion we have done in this forum, or whatever stocks we have discussed, are not to be construed as any advice. Whatever numbers we have discussed in terms of returns are not to be kind of construed as any expected earning, any expected, I would say, returns from equity. These are all for the discussions. These are those fund managers who have done the best. One doesn't know how will they perform in the future, because future is uncertain. They're all trying their, I would say, best with their own processes. And Pankaj, I'll definitely do a webinar with you. Would want to understand your views on market, because at present we want to understand your views, particularly given your, I would say, approach and your, I would say, risk focused mechanism. And thank you everyone for joining today. Thank you for your time. Over to you, Aishwarya.